The 10 Secret Pillars of Stock Market Investing by John Fitzgerald. Intro. Hey buddy, I want to talk to you. Not with big words, but with real ones. You've come into the market. You've seen noise. You've seen hype. You've seen people win and people lose. The difference is not luck. It's foundation. It's the pillars beneath their decisions. Today, I'll share with you the 10 secret pillars. They are not shortcuts. They are not magic tricks. They are habits. They are mindset. They are guardrails. They are the quiet strength that keeps your money safe and growing over time. Take a breath. Open your heart. Take a notebook. Let's walk through them, one by one, like friends do. Chapter 1, Long-Term Thinking. Most people chase quick wins. They react to daily noise. You must think in years, not days. Invest in stories that last, not in moments that flash. Time is your ally, if you give it space. Small seeds become tall trees. Compounding works slowly at first. Then it accelerates. The early years feel quiet. That's when most people quit. Don't let your winners breathe. Let them grow. Write down your goal. Ask yourself, what do I want in 5 years? What do I want in 10? If you invest today, with that horizon, you'll endure the storms. Short-term panic will come, but your long-term view will keep you steady. Real wealth isn't built in days. It builds while you sleep. You just have to stay. Chapter 1, Long-Term Thinking, Deep Dive. Most people come to the market hungry. They want quick proof. They want fast wins. That hunger makes them chase noise. They trade every headline. They react to every dip. They burn their attention. Long-term thinking is the opposite. It is calm. It is patient. It is a promise to yourself. It says, I will give this time. I will hold through the shaky days. I will focus on the future. While long-term thinking wins, time compounds. Small returns stack on small returns. They turn into big ones. The magic is hidden in the quiet years. The early phase looks slow. Most people get bored. They leave. Then they miss the explosion. That explosion is not luck. It is built on years of growth. The longer you stay, the more the growth accelerates. Simple numbers to feel it. Start with $1,000. Give it 12% annually. After 1 year, it becomes $1,120. After 5 years, it becomes about $1,762. After 10 years, it becomes about $3,105. After 20 years, it becomes about $9,646. See the curve. It gets steeper with time. The jump from year 10 to 20 is bigger than year 0 to 10. That's compounding with patience. The psychological trap. You will see ups and downs. You will feel fear in drops. You will feel greed in spikes. The short-term noise will scream louder than you plan. If you chase it, you cut your own fruit early. Long-term thinking builds tolerance. It teaches you to ask, is this temporary? Does this change the big story? You learn to pause before reacting. You learn to breathe, aligning goals with horizon. Ask yourself, why am I investing? For retirement, for a house, for freedom. Write the time frame. Is it 3 years, 5 years, 15 years? Long-term thinking needs a horizon. Without it, you wander. With it, you get direction. The rewind test. Imagine you bought today. Now rewind 5 years. Would you still have invested? Would you ignore the daily noise? Would you hold through a 30% drop? If yes, you probably chose something durable. If no, you might be chasing surface appeal. Common mistakes. Chasing hot tips. Switching every month. Selling at the first red candle. Overreacting to news. Ignoring the plan because of a short-term gain. Believing that this time is different. Without evidence. Practical steps. Write your 5-year financial goal. Write your 10-year vision. Choose businesses you believe will still matter then. Set a review cadence. Quarterly or yearly. Ignore daily price chatter. Track progress, not noise. Mini case study. Sarah bought a steady consumer brand. She believed in its products. She planned for 15 years. In year 2, the market dipped 40%. Her friends panicked. She stayed. In year 7, the brand doubled revenue. In year 12, dividends grew every year. Her initial small investment became a core holding. The secret was simple. She let time work. Checklist before you buy. Do I understand the long-term story? Is the time horizon aligned? Can I hold through a bad year? Am I buying for decades or days? Have I written down the goal? Am I reacting or planning? Reminder: long-term thinking is a habit. It grows stronger with practice. The market will test it. When it does, remember why you started. Stay. Give it time. Let the quiet years do their work. Chapter 2: Understand the business. Never invest in something you don't get. If you can't explain how it makes money, stay away. Know the core, know the customer, know the model, know the risks. This is your circle of competence. Stay inside it. Expand it slowly. Learn before you leap. Because confusion costs. Clarity gives calm. Read reports. Watch leadership. Use the product if you can. Ask, why do people buy this? Who is the competition? Is this sustainable? When you understand the business, you are not a trader. You become an owner. Owners think differently. They don't sell in fear. They don't buy in noise. They hold with conviction. Chapter 2: Understand the business deep dive. Never invest in something you can't explain. Not to an analyst, not to a banker, but to a friend. If you can't put it in simple words, you don't truly understand it. Your circle of competence. Every investor has a circle. Inside that circle are industries, products, and business models you know well. Outside it is danger. The problem: people stretch too far too soon. They chase hot sectors they can't even describe. They hope the hype will carry them. It usually doesn't. Why understanding matters. When you know a business, you see its patterns. You know what's normal. You know what's a red flag. You know when a dip is temporary and when it's a real threat. You don't get shaken by headlines. You don't sell in panic. You hold with conviction because you understand the foundation. How to truly understand a business. Study the model. How does it make money? From products, services, recurring subscriptions. Know the customer. Who buys from them? Why do they buy? Can that change easily? Check the competition. Are there barriers? Does the company have a moat? Can others copy it fast? Look at the financials, profit trends, debt levels, cash flow stability. Test the product yourself. If possible, use it. See the quality. Feel the value. The danger of "I'll figure it out later." Investing in a business you don't understand is like buying a machine without knowing how it works. You won't know if it's broken. You won't know how to fix it. You'll only see the outside. By the time you realize it's failing, it's too late. Mini case study. Tom heard about a biotech stock. Everyone said it would double. He bought big. He had no clue what the company actually did. Months later, a key trial failed. The stock collapsed. Tom lost half his money. He didn't even understand why it happened. Meanwhile, Linda bought shares in a retail chain. She shopped there often. She knew the stores, the customer base, and the business model. When a temporary slump came, she knew it was due to seasonal slowdowns. She held on. A year later, sales bounced back. Her patience was rewarded. Questions before you invest. Can I explain how this business makes money? Do I know who their customers are? Do I know their biggest risks? Do I understand the competitive landscape? Can I track the industry easily? If the answer is no to any, learn more before buying. Reminder: invest in clarity, not mystery. Understanding makes you confident. Confidence keeps you patient. And patience lets compounding work. Chapter 3: Price vs Value and Margin of Safety. Price is what you pay. Value is what you get. They are rarely the same. Smart investors hunt gaps. They look for value above price. They build a cushion. That cushion is margin of safety. It protects you from mistakes, from uncertainty, from the unexpected. If a business is worth $100, buy it at $70 or less. That difference is your shield. It lets you breathe when markets wobble, because you're not depending on perfection. You are depending on a buffer. Estimate intrinsic value. Be conservative. Don't fall for fads just because the chart is shiny. Cheap isn't always good. Expensive isn't always bad. If real value is there, a wise buy today can become your fortress tomorrow. Chapter 3: Price vs Value and Margin of Safety Deep Dive. Price is simple. It's the number you see on the screen. Value is deeper. It's what the business is truly worth. Price changes every day. Value changes much slower. The gap between price and value. Sometimes the market overprices a business. It gets carried away by hype. Sometimes it underprices a business. It panics over short-term issues. Your job is to spot the difference. Not to follow the crowd. Not to buy just because the chart is moving. But to compare what I'm paying, with what I'm getting. Margin of safety. This is your safety net. If a business is worth $100, don't buy it at $100. Buy it at $70 or $60. Why? Because your calculations could be wrong. Unexpected events can happen. The margin gives you room for error. It's your shock absorber. It turns a good investment into a great one. Why it matters? Markets are unpredictable. Even the best businesses can face surprises. Regulations can change. Competitors can emerge. Economic cycles can hit earnings. With no margin of safety, one bad year can sink your return. With a margin, you can survive the storm. How to estimate value? Study the financials. Look at profits, assets, cash flow. Understand the business moat. What keeps it ahead? Project conservative growth, not the rosy numbers from high particles. Use valuation methods, like discounted cash flow (DCF), or pay ratio comparison with history. Cheap is not always good. A stock can be cheap for a reason. If the business is broken, a low price won't save you. Always ask, is the business healthy, or is it in decline? Buy value, not just low numbers. Mini case study. Jake saw a stock at $15, down from $30. He thought it was a bargain. But the company's main product was becoming obsolete. It wasn't undervalued. It was dying. Jake lost 70%. Meanwhile, Sophie found a strong company worth $100. It was trading at $65. Due to temporary market panic, she bought. Within 3 years, it was back to $120. Her margin of safety made the win easier. Questions to ask before buying. What is the intrinsic value? Am I paying much less than that? Is the business fundamentally strong? Do I have a safety cushion? If things go wrong, reminder, price is what you pay. Value is what you get. Margin of safety is what keeps you in the game. When the unexpected happens, don't chase high prices blindly. Don't buy junk just because it's cheap. Buy value. Buy safety. Buy with patience. Chapter 4, Control Emotions, Fear and Greed. The market plays on feelings. Fear makes you run. Greed makes you jump. Both derail you. When everyone is buying, pause. Ask, why is everyone excited? When everyone is selling, look deeper. There is opportunity hidden in panic. Remember the rule. Be fearful when others are greedy. Be greedy when others are fearful. Write your plan before the storm. Stick to it during the noise. Label your emotion. Ask, am I acting from fear or from logic? The loudest voices are not always the wisest. Calm beats chaos. Long-term thinking beats short-term reaction. Chapter 4, Control Emotions, Fear and Greed Deep Dive. The market is a mirror. It reflects not just numbers. It reflects emotions. Two emotions rule here, fear and greed. Fear. Fear makes you sell too early. Fear makes you avoid opportunity. When prices fall, fear tells you, get out before it's too late. It whispers worst-case scenarios. It makes you forget why you bought in the first place. It blinds you to long-term potential. Greed. Greed makes you buy too much. It makes you chase a stock just because it's going up. It whispers, don't miss out. That's FOMO, fear of missing out. Dressed as greed, it pushes you to risk more than you can afford. It tells you, this will never go down. And that's when the fall hurts the most. Why they're dangerous. Fear and greed make you break your plan. They replace logic with impulse. They push you into buying high and selling low. They keep you jumping instead of holding. The Warren Buffett rule. Be fearful when others are greedy. Be greedy when others are fearful. Simple words. Hard to follow. They require courage. They require trust in your process. How to control emotions. Write your plan before investing. Include entry price, exit price, and reason for buying. Decide risk before you buy. Know how much you can lose without panic. Limit news noise. Avoid checking prices every hour. Review quarterly, not daily. Stick to the schedule. Ask why before acting. Is this decision based on data or on a feeling? Mini case study. Mark bought a strong company. A month later, the market dipped 20%. Fear told him to sell. He remembered his plan. He held on. 2 years later, the stock doubled. The fear was temporary. The value was real. Another case. Lisa saw a stock rising fast. Greed told her to buy big. She ignored the fundamentals. Within weeks, the stock crashed. Greed gave her a quick thrill, then a lasting loss. Questions to ask yourself. Am I making this move because I am scared? Or because I see real risk? Am I buying because I believe in value? Or because I'm afraid of missing out? Reminder, fear and greed will always be there. You can't kill them, but you can control them. Follow your plan. Stick to your rules. Let logic lead, and let emotions follow quietly. That's how you win. Chapter 5, Risk Management and Capital Preservation. Your first job is to protect capital. Second is to grow it. Big gains mean nothing if your base is broken. Never put all your weight on one thin branch. Position size matters. Know how much you can lose. Use stop losses thoughtfully, but don't panic on every dip. Diversify where needed. Hold cash as dry powder. Avoid over leverage. Debt can amplify losses. Ask what can go wrong. Then build against it. Small losses are recoverable. Huge ones take years to fix. Play defense so your offense can work later. Chapter 5, Risk Management and Capital Preservation. Deep dive. In the market, your first job is not to make money. Your first job is to keep the money you already have. Growth comes later. Protection comes first. Why capital preservation matters. If you lose 50% of your money, you need a 100% gain just to get back to where you started. That's not easy. Losses hurt more than gains help. So your defense must be strong. Before you play offense, risk is not the same as volatility. Price moves up and down every day. That's volatility. Risk is the chance you lose your capital permanently. Volatility is normal. Permanent loss is not. Principles of risk management. Position sizing. Never put too much into a single stock. Spread risk across multiple holdings. Stop losses and alerts. Decide in advance when you'll exit. If things go wrong, diversification. Hold assets in different sectors, so one storm doesn't sink your whole ship. Cash reserve. Keep some money ready for emergencies, for opportunities in market downturns. Avoid over leverage. Borrowing to invest can turn small drops into disasters. Why most people ignore risk? Because it's not exciting. Risk control doesn't make headlines. It doesn't feel like winning until the market turns. Then, it's the only thing that matters. Mini case study. David invested 80% of his portfolio into one high-flying tech stock. It dropped 60% in a crash. His entire portfolio collapsed. He had no cash left to buy anything else. Meanwhile, Alex spread his money across 10 solid companies and kept 15% in cash. When the market dipped, he used that cash to buy more of his best companies at a discount. 2 years later, his portfolio was stronger than ever. The mental side of risk management. It's about accepting that you won't be right all the time. It's about planning for the times you're wrong. It's about humility. And it's about survival. Questions before you invest. How much am I willing to lose here? If this goes wrong, will I still have enough to keep playing? Am I prepared for unexpected events? Reminder, you can recover from a missed gain. You can't recover from being wiped out. Protect your capital, like it's your oxygen. Because in the market, once you lose it, the game is over. Chapter 6, Diversification vs Focus. Spreading too much dilutes attention. Putting all in one spikes risk. Find the balance. Own a few great businesses. Keep them in different pockets. Know each one. Too many, and you stop watching. Too few, and one blow can hurt badly. Start broad if you're new. Then narrow, as your conviction grows. 8 to 15 good positions can give clarity and protection. Monitor what you own. Don't buy random names. Buy with purpose. Chapter 6, Diversification vs Focus. Deep dive. Diversification is safety. Focus is power. You need both, but in the right balance. What is diversification? It means spreading your investments across different companies, different industries, and sometimes even different asset types. Why? Because no matter how good a stock looks, something unexpected can go wrong. If all your money is in one place, one bad event can destroy everything. Diversification softens the blow. When one holding falls, others can hold you up. What is focus? Focus means putting more weight into your best ideas. It's about knowing your winners deeply and backing them strongly. Too much diversification, and your attention is scattered. You own so many companies. You can't track them all. Your portfolio becomes average. The danger of extremes. Over diversification equals safety without growth. Over focus equals growth without safety. Both are risky in their own way. The key is balance. Finding the balance. If you're new, start more diversified. It reduces mistakes while you are learning. As you gain skill and confidence, narrow your holdings. Focus more on the businesses you understand best. For most investors, 8 to 15 quality stocks is a healthy range, enough to protect you, enough to let you focus. Sector diversification matters too. Don't put all your stocks in one industry. If you own 10 tech stocks, you are not truly diversified. Spread across sectors: technology, finance, consumer, healthcare, energy. Different sectors respond differently to the economy. This creates a smoother ride. Mini case study. Brian owned 30 different stocks. He couldn't keep up with earnings reports. He missed warning signs. When some stocks dropped, he didn't even know why. Sarah owned 10 stocks. She knew each one well. She followed their industry news. She understood their risks and opportunities. Her portfolio stayed strong, even when the market turned rough. Questions to ask yourself. Do I know every company I own? Can I explain why it's in my portfolio? Am I too concentrated in one sector? Do I have enough focus to track each holding? Reminder: diversification is your shield. Focus is your sword. Too much shield, and you never attack. Too much sword, and you leave yourself open. Balance them, and your investing journey becomes both safer and stronger. Chapter 7. Stick to the plan. Noise is everywhere. Headlines shout. Friends give hot tips. If you don't have a plan, you'll drift. Write your rules. Define your goals. Set your time frame. Choose your types of businesses. Decide your risk limits. Know when you'll exit. Review rarely. React less. Emotions want you to jump. Your plan wants you to stay. Trust the plan, unless the logic changes. Chapter 7. Stick to the plan. Deep dive. The market is full of noise. Headlines scream. Social media buzzers. Friends send hot tips. If you don't have a plan, you'll drift with every wave. Why a plan matters. A plan is your compass. It keeps you moving toward your goal, no matter how wild the weather gets. Without it, your decisions are random. You buy because someone said so. You sell because you got scared. You chase gains. You avoid dips. And in the end, you go nowhere. What a plan should include: your goal. Why are you investing? Retirement, a home, freedom, your time horizon. When will you need the money? Your investment style, growth, value, dividends, your risk limits. How much can you lose without panic? Your exit strategy. When and why will you sell? Why sticking to the plan is hard? Because emotions fight it. Fear whispers, get out now. Greed shouts, double down. Both can make you ignore your plan. The market tempts you with constant distractions. How to stick to it? Write your plan down. Keep it visible. Review it before making any move. Set rules like: I will not buy without research. I will not sell without reason. Limit how often you check prices. Decide review times, monthly or quarterly. Mini case study. Anna had a 10-year plan to build a dividend portfolio. Year 2, markets dipped. Everyone around her was selling. Her plan said, hold and reinvest dividends. She did. Years later, her income doubled, and she stayed on track. Another case. Mike had no plan. He bought whatever was trending. He sold whenever it fell a little. He kept jumping from one stock to another. After 5 years, his portfolio barely grew. The problem wasn't the market. It was his lack of direction. Questions to ask yourself. Do I have my goals written down? Do I know my holding period? Do I have rules for buying and selling? Am I breaking my plan because of emotion or logic? Reminder: The market will always try to test you. It will tempt you to break your own rules. But a plan only works if you follow it. Stay disciplined. Trust your strategy. Your plan is your anchor. In the storm. Chapter 8, Continuous Learning. The market evolves. What worked yesterday can fade tomorrow. Learning keeps your edge sharp. Read, observe, reflect. Learn from winners. Learn from your losses. Study trends. Stay curious. New industries rise. New risks appear. If you stop learning, you start losing. The best investors are lifelong students. They update their mental models. They adapt. They don't assume they've arrived. Knowledge builds better judgment. Chapter 8, Continuous Learning Deep Dive. The market never stops changing. New trends emerge. Old giants fall. Rules shift. Industries evolve. If you stop learning, the market will leave you behind. Why continuous learning matters. Knowledge compounds just like money. Every bit you learn makes you better prepared for the next decision. The more you understand, the calmer you stay in chaos. The less you know, the easier you are to shake. What to learn? Learn the businesses you own. Learn the industries therein. Learn how the economy affects them. Learn new tools and strategies. Learn from history, because market patterns repeat. Where to learn? Books. Read classics by investors like Buffett, Graham, Lynch. Annual reports. They're a goldmine of business insight. Trusted financial news. Filter out the noise, keep the facts. Courses and workshops. Skills can be sharpened anytime. Your own portfolio. Review past trades. See what worked, what didn't. The humility of learning. Learning means admitting you don't know everything. It means staying curious, even when you've had success. The moment you think you know it all, you stop growing, and the market punishes stagnation. Mini case study. John started investing in his 20s. He read constantly. Every loss he treated as tuition for a lesson. He stayed updated with industry changes. By 50, he built a fortune steadily, avoiding big disasters. Mike started at the same time. He learned in the beginning, but stopped once he made a few wins. When the market changed, his old strategies stopped working. He didn't adapt. He lost most of what he'd gained. Questions to ask yourself. What have I learned this month that makes me a better investor? Am I reading more than I am reacting? Do I review my own mistakes regularly? Am I staying curious? Reminder, the best investors are lifetime students. They treat knowledge as their most valuable asset. Because money without knowledge is temporary, but knowledge can create money again and again. So keep learning, every day, every year, forever. Chapter 9, Contrarian Thinking. The crowd is loud. The crowd is emotional. Following the herd often means buying high and selling low. Contrarian thinking is not blind opposition. It's thoughtful difference. When fear is thick, opportunity can hide there. When greed is loud, truth can be risky. Check the data. Ask questions. Look where others look away. That's where true edge lives. It takes courage, not to follow, but to pause and decide. Chapter 9, Contrarian Thinking Deep Dive. The crowd is loud. The crowd is emotional. The crowd feels safe because it moves together. But safety in numbers can be an illusion in the market. What contrarian thinking really means. It's not just doing the opposite of everyone else. It's questioning what the crowd believes. It's asking, is this move driven by logic or by emotion? It's looking beyond headlines. It's trusting your research when it points in a different direction. Why the crowd is often wrong. In euphoria, people overpay. In panic, they sell at any price. Crowd behavior swings between extreme greed and extreme fear. If you follow them blindly, you buy high and sell low. Being a contrarian takes courage. It's hard to buy when everyone around you is selling. It's hard to sell when everyone is screaming, buy. You'll feel doubt. You'll feel pressure. People will say you're crazy. But the market rewards those who think for themselves. The role of data. Contrarian thinking is not guessing. It's based on facts, analysis, and patience. If the data says a business is strong, but the price has fallen because of short-term fear, that might be your opportunity. If the data says a stock is overvalued, but hype is pushing it higher, that might be your warning to exit. Mini case study. In 2008, panic ruled the market. Banks were failing. Stocks crashed. Most investors dumped their holdings. But a few looked deeper. They bought strong companies at historic discounts. 5 years later, those investments multiplied, not because of luck, but because of courage to act when others ran. The danger of blind contrarianism. Doing the opposite, just for the sake of it, is not smart. Sometimes the crowd is right. The key is to know why you are going against them. It must be backed by clear reasoning and evidence. Questions to ask yourself. Am I following the crowd because it feels safe? Am I going against it because of solid research, or just to be different? What does the data actually say? Reminder, contrarian thinking is a skill. It's about patience. It's about courage. And most importantly, it's about independent judgment. The market's best opportunities often come when the crowd is running the other way. Your job is to know when to take that road. Chapter 10, Patience in Compounding. Patience is the quiet power. Compounding is the engine. Together they build wealth like nothing else. Small gains today become big fortunes later. Early years feel slow. Most give up there. If you stay, time multiplies your effort. Reinvest gains. Let profits work again. Don't tinker constantly. Let winners run. Hold. Give time a chance. The difference between 20 years and 30 years is exponential. Plant the seed. Water it. Then step back. Chapter 10, Patience in Compounding. Deep dive. Patience is quiet. Compounding is invisible. But together, they are unstoppable. What is compounding? It's your money earning returns. And those returns earning more returns. Year after year. It starts small. It feels slow. But over time, it explodes in growth. Why patience matters? Compounding needs time to work. If you interrupt it, you kill its power. Most people can't wait. They want quick wins. They cash out too early. And they lose the big reward. The compounding curve. In the first few years, growth feels flat, but then it curves upward. The gains in later years are larger than all the early years combined. The secret is simply staying invested long enough to reach that curve. Simple example. Invest $10,000 at 10% annual return. Year 1, $11,000. Year 10, $25,937. Year 20, $67,275. Year 30, $174,494. The jump from year 20 to year 30 is more than the entire gain from year 0 to 20. That's the magic of compounding. Patience through the noise. Markets will dip. News will scare you. Friends will brag about faster gains elsewhere. But patience means trusting your process. It means letting time do the heavy lifting. Mini case study. Emma bought shares in a solid company. She planned to hold for 20 years. In year 3, the market dropped 30%. She didn't sell. In year 10, the dividends alone covered her living expenses. By year 20, her investment had grown over 5 times. All because she stayed. The danger of breaking compounding. Every time you pull money out early, you reset the clock. You shrink the snowball. You lose the acceleration. Patience protects the snowball and lets it grow into an avalanche. Questions to ask yourself. Am I thinking in decades or days? Do I understand the cost of interrupting compounding? Can I resist the urge to cash out early? Reminder. Patience and compounding are the silent partners in your success. They don't shout. They don't rush. But they will change your life. If you let them. Plant the seed. Water it. And then step back. Time will do the rest. Outro. So that's it, my friend. 10 pillars. Not flashy. Not trendy. Real. Built on discipline. Built on thought. Built on time. If you carry these with you, the market stops being a game of luck. It becomes your canvas. Protect your capital. Think long. Understand what you own. Buy value, not hype. Control your emotions. Manage risk. Balance focus and spread. Stick to your plan. Keep learning. Dare to be different. And give time its work. You don't need to be perfect. You need to be consistent. I'm with you in this journey. This is ABD of Finance. Keep growing. Keep believing. Until next time, stay patient. Stay wise. Stay invested.